Thank you, ICANN and SAFA, for providing me an opportunity to share the experiences regarding transfer pricing issues in Nepal. As per our previous paper presenters, we in Nepal yet don't have any rich experiences to share regarding transfer pricing issues, as the directive has just yet been promulgated by the IRD. So I would limit my presentation regarding the topics covered by the directives alone, and later, sometime after we gain a rich experience, we will definitely share the experiences with our neighbors and wider world. So the first slide that I would like to share is regarding the definition of transfer pricing that has been, okay, I will share the full screen. The transfer pricing definition shared by OECD transfer pricing guideline is that the transfer prices are the prices at which an enterprise transfers physical goods and intangible property or services to associated entities. And the similar definition has been shared by the United Nations Practical Manual on Transfer Pricing. I'll not go into the details of definition, and I'll skip to the next slide, which is related to the Transfer Pricing Directive 2081. This directive was issued on 6th October 2024 by IRD, that is the line department regarding income tax, excise, and VAT in Nepal. The need for this directive or the transfer pricing law regime in Nepal was stressed by the finance minister in his speech, in the budget speech of 2024. And the law came in the form of a directive rather than a full-fledged law backed by the authority of the parliament. So, in a sense, we can tell that this is a form of delegated legislation. The directive contains 7 chapters and 2 annexures. Now, I would like to move into the chapters of the directives. There are 7 chapters in the directive. And the first chapter is the introduction, then the definition, and so on and so forth, as can be seen in the screen. The chapter 1 is basically the introductory chapter. It spells out the rationale of why the transfer pricing directive was issued by the IRD. The main essence of introducing the directive was to enable the government of Nepal to gain a fair share of tax based on ALP between the subsidiaries of multinational companies in Nepal and its headquarters. And the source of the directive is Section 3, subsection 3 of Section 33 of the Income Tax Act that was introduced in the current year's budget, that is by the Finance Act 2024. As can be seen in the screen, Section 33 of the Income Tax deals regarding transfer pricing and other arrangement between associated parties. The subsection 3 of the Section 33, which was inserted by the Finance Act 2024, provides that the transfer pricing between the associated enterprise shall be as determined by the IRD. And it is by the virtue and the authority of this section 3, subsection 3 of the 33, that the current transfer pricing directive was issued. Moreover, the rule 15 of the income tax rules also deals with advance pricing arrangement. The current directive is silent about APA regime, but we hope that APA regime would be introduced at a later stage as we advance in transfer pricing regime. Chapter 2 basically is the definitive section. It provides definition regarding various terms in the directive. Other terms have been verbatim copied by the directive, as was in the Income Tax Act. The phrases or the words that can be seen on the screen are the new definitions that have been added. These are the key terms in the directive that has been added, as I said, and the others words or the definitions were verbatim copied from the erstwhile act, the present act 2058 or 2001 AD. The chapter 3 is regarding transfer pricing and arm's length price. This chapter basically deals with the principle of transfer pricing and the arm's length principle. And in brief, in a very short form, it in a figurative way, it deals with the principles of determination of ALP and further elaborates on these principles at a later chapter. The chapter 4, which is the main crux of the directive or the backbone of the directive, is the compatibility analysis. The three steps in compatibility analysis, mainly the transactional analysis method, the transaction analysis, functional analysis, and compatibility analysis have been spelled out in the chapter 4. Moreover, the steps in the compatibility analysis have been put in detail in the directives. Due to the paucity of time and the space given to me, I'm unable to delve into the details of the each and every point, but the 6 points that have been mentioned in the directives are the analysis of economically significant characteristics of the business and transaction, examination of compatibility factor and control transaction, selection of tested party, identification and selection of comparables, appropriate adjustment to comparables, and selection of the appropriate arm length method. Section 5 is the method of arm length price determination. As our previous speakers have spoken about, these 5 methods uh, accepted worldwide and also in the UN and the OECD manuals and the regulations. These 5 methods are comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, and transactional profit split method. So the issue comes if while doing the compatibility analysis, if we get more than one comparables, then what to do? The directives guides that the two methods that can be used if we have multiple comparables are the median range method and average method. If the data sets are more or equal to 7, then the median range is to be followed. And if the data sets are 6 or less than 6, then the average method is to be followed. And the tolerable limit or the error is 5%. And while following the median method, the 35th and 65th percentile method has been chosen. The arm length falls within these two, 35 to 65th percentile. I'll not go into the details of the calculation in median method and the average method. That can be, I think, be later visited after I share the slides to the icon. I'll move into the chapter 6. That is the requirementation of maintenance of transfer pricing documentation. Chapter 6 tells that the entities that have transaction of 100 million rupees or approximately 740 USD at current forex terms need to maintain transfer pricing documentation as mentioned in Annex 1 of the directive. Moreover, so that the data and the information submitted to tax office is accurate and verified, a certification or an attestation requirement has been placed if the transaction or the offshore transaction is of the value 500 rupees or more, that is approximately 3.7 million USD at current value terms. So the documentation that has to be kept as per Annex 1 are in basically 3 points. That is the documentation regarding information of the entities, documentation relating to offshore transaction between associated enterprises, and document regarding determination of price as per ALP. If we revisit our previous speakers, there were requirements regarding master file, local file, and country by country reporting. No such requirement have been specified in this current directive. We hope that this will be amended at a later time when the need arises by IRD. And the final chapter is the transfer pricing administration. What this directive has done is that it has not introduced new sections regarding amendment assessment, serving of the notice, penalty levied for not filing of documentation or filing of wrong documentation. What it has done is that it has incorporated the transfer pricing regime within the ambit of the current Income Tax Act. So the provisions that were applicable for the filing of the tax returns at the present time has been equally applied for transfer pricing regime. So no new provisions or sections have been introduced in that front. So these are the uh, chapters that the directives have introduced. Now I will put three concluding remarks on my presentation, and I would devote 3 slides only for my concluding remarks. That is the preparation for tax authorities. Transfer pricing regime is a new terrain for tax authorities in Nepal as well. So the first and foremost task would be in identifying the number and the type of MNCs operating in Nepal, and at the same time identifying the transfer pricing risks involved. Because there are no prior experiences regarding transfer pricing regime to the IRD officers or tax office, and also due to the scarcity of resources, identifying and maintaining database of comparable transaction would be challenging. So the IRD should assess the current gaps and current capabilities regarding this matter, and also a coordination between various government agencies is a must for proper and effective transfer pricing regime in Nepal. Regarding the business community front, TP policies are normally harmonized across the countries as MNCs are well versed with the experiences of transfer pricing, but are not so abreast with these working. So, and also there is an uncertainty over double taxation risks and the documentation and the compliance requirement to meet the law of the land. So, in spite of the head offices of the MNCs having, I'll finish it within a minute. So, in spite of the head offices of the local units having experiences in Nepal, at the initial stage, the head offices should handhold regarding the maintenance of documentation, as the local unit would lack the expertise and skills. And also, the MNCs must strictly comply with the directive and other best international practices regarding transfer pricing. And this is the last slide of my presentation. So, what's lacking in the directive? The elephant in the room that has been hidden is the advanced pricing arrangement. That is an issue that the directive should address in the future. Safe harbor rules are equally important for truly and vibrant TP regime. So these are absent, and the provisions that are absent are the provisions regarding intangibles and marketing intangibles. As in the today's world, intangible assets are the most important assets, and the conspicuous absence of these provisions should be addressed by the tax authorities in the near future. And also, the draftsmanship of the current directive is also an issue, because it is an hotspot of examples, principles, and substantive provisions rather than a bare act that can be seen in drafting other acts. So I think these are the issues that the tax authorities should address in the future. As the time comes, I can, and we as the practicing chartered accountants would definitely help IRD in solving these issues. And with this, I would like to say thank you and end my presentation here.